If you are a homeowner over the age of 60 and you have not reviewed your tax situation in the last 12 months, the next few minutes could be the most important financial warning you received this year. I am not saying that for dramatic effect. I am saying it because what is quietly unfolding inside the IRS right now has the potential to put liens on homes, drain retirement savings, and create financial chaos for seniors who never even realized they were out of compliance. And the window to fix it is closing on April 15th, 2026, not sometime this spring. Not before the end of the year, April 15th. That is the line in the sand. And once it passes, your options shrink dramatically while the penalties do not. I have spent years studying IRS enforcement patterns, tax code changes, and the way federal policy impacts everyday Americans, especially older Americans who have spent decades building equity in their homes and planning for a stable retirement. And I can tell you with complete confidence that what is happening right now in 2026 is unlike anything I have seen in terms of how aggressively the IRS is going after unreported property related transactions among seniors. This is not speculation. This is not a scare tactic. This is a documented shift in enforcement priority backed by billions of dollars in new IRS funding and technology that did not exist even 3 years ago. So here is what I need from you. I need you to stay with me through this entire video. Do not skip ahead. Do not click away after the first few minutes thinking you have heard enough, because the information I am going to walk you through builds on itself, and the action steps at the end only make sense if you understand the full picture. And if you have a parent, a spouse, a sibling, a neighbor, anyone over 60 who owns property, send them this video right now, not later, right now. Because the people who are most at risk are almost always the last ones to find out. Let me start by explaining why 2026 is the year everything changed. For decades, the IRS operated with a limited budget, an aging technology infrastructure, and a relatively small enforcement staff relative to the number of returns filed every year. That meant audit rates were low. Compliance gaps went undetected for years, and millions of Americans, many of them seniors, were making common financial decisions involving their homes without ever being told those decisions had tax reporting requirements. They added a child to their deed to avoid probate. They took out a home equity line of credit to cover medical bills. They rented a spare bedroom on Airbnb to supplement their Social Security. They inherited property from a spouse or a parent and simply continued living in it or holding it. Every single one of those actions, everyone can trigger a specific IRS reporting obligation. And for years, most people had no idea because the IRS did not have the capacity to catch the gaps. That era is over. In 2022 and 2023, Congress authorized approximately $80 billion in new funding for the IRS through the Inflation Reduction Act. A significant portion of that funding was earmarked specifically for enforcement and technology modernization. The IRS used that money to build something that fundamentally changes the game for every property owner in America. They built automated data matching systems that pull information from county property records, mortgage lenders, home equity loan servicers, title companies, short-term rental platforms like Airbnb and VRBO, and estate and probate filings. All of that data now flows into IRS systems where artificial intelligence and machine learning algorithms compare it against filed tax returns looking for discrepancies. And the demographic that is being flagged most frequently right now is Americans over 60 who own homes with significant equity. Not because the IRS is targeting seniors out of malice, but because this demographic has had more of these unreported triggering events occur in recent years than any other group and has historically been the least likely to know that reporting was required. Let me be very specific about what these triggering events are because there is a high probability that at least one of them applies to you or someone you care about. The first and most common triggering event is taking out a home equity loan or a home equity line of credit and using the funds for something other than home improvement. This has become incredibly common among seniors over the last several years. With inflation driving up the cost of groceries, utilities, prescription medications, and everyday living expenses, millions of older Americans turn to their home equity as a financial lifeline. Maybe you took out a HELOC to pay off credit card debt that had spiraled during the pandemic. Maybe you used it to help a grandchild with college tuition. Maybe you needed it for a medical procedure that insurance did not fully cover. Those are all perfectly understandable decisions. But here is what your lender almost certainly did not tell you when you signed the paperwork. Under current tax law, specifically the changes made by the Tax Cuts and Jobs Act of 2017, which remain in effect through 2025 and are now subject to new enforcement intensity in 2026. Home equity loan interest is only deductible if the loan proceeds were used to buy, build, or substantially improve the home that secures the loan. IRS Publication 936 spells this out clearly. If you use the money for anything else, medical bills, debt consolidation, tuition, living expenses, the interest is not deductible. Period. And if you or your tax preparer claim that interest as a deduction on Schedule A of your tax return, you have an incorrect deduction on file that the IRS can now identify through their lender data matching systems. The penalty for an improper deduction starts with the additional tax owed on the amount that should not have been deducted plus interest calculated from the original due date of the return plus a potential accuracy-related penalty of 20% of the underpayment under IRC Section 6662. For a senior on a fixed income, that combination of back taxes, interest, and penalties can easily reach several thousand. The second triggering event is one that catches more people off guard than almost anything else I cover on this channel. It is the partial transfer of property, specifically adding a family member to your home's deed. This is something that millions of seniors have done over the years, usually with the best of intentions. You add your adult son or daughter to the deed, so the house passes to them automatically when you die without going through probate. Or someone, maybe a friend, maybe a financial advisor who is not a tax specialist, told you it would protect the home from Medicaid recovery, or you simply wanted to make things easier for your family. I understand all of those motivations. They make complete sense from a family planning perspective. But from a tax perspective, adding someone to your deed is not a simple administrative change. It is a transfer of a partial interest in real estate, and the IRS treats that transfer as a gift. Under IRC Section 251, the transfer of property by gift is a taxable event when the value exceeds the annual gift tax exclusion. For 2026, that exclusion is $18,000 per recipient. If your home is worth $400,000 and you gave your child a 50% interest in it, you transferred $200,000 in value. That means you were required to file IRS Form 709, the United States Gift and Generation Skipping Transfer Tax return for the year in which the transfer occurred. Not filing Form 709 when required is a reporting violation that carries its own penalty structure under IRC Section 6651. And here is the part that makes this particularly painful for families. When you give property as a gift during your lifetime, rather than leaving it as an inheritance at death, the recipient gets your original cost basis in the property, not the current market value. That is called carryover basis. But when someone inherits property at death, they receive what is called a stepped-up basis, meaning their basis is the fair market value at the date of death. The difference between those two outcomes can be enormous. If you bought your home for $80,000 30 years ago and it is now worth $400,000, your child inheriting it at your death would get a stepped-up basis of $400,000 and could sell it with little or no capital gains tax. But if you gifted them a 50% interest while you were alive, their basis on that 50% is only $40,000. If they sell after your death, they could face capital gains tax on the difference between $40,000 and whatever the home is worth at that point. We are talking about tens of thousands of dollars in unnecessary tax liability created by a decision that was made with good intentions, but without full information. And the IRS is now identifying these unreported gift transfers by cross-referencing county deed records against Form 709 filing records. If a deed change shows up in county records, but no corresponding Form 709 was filed, the system flags it automatically. The third triggering event involves rental income from your primary residence. And this one has exploded in recent years because of how easy platforms like Airbnb and VRBO have made it to rent out a room, a basement, or even your entire home while you travel. For seniors on fixed incomes, the extra few hundred a month from renting a spare room can be genuinely life-changing. It can mean the difference between covering your property taxes comfortably or falling behind, between affording your medications or having to make difficult choices. I understand the appeal completely, but the moment you begin receiving rental income from any portion of your primary residence, you have changed the tax character of that portion of the home from personal use to income-producing use. That means the rental income must be reported on Schedule E of your tax return. It means you must properly allocate expenses between personal use and rental use. And critically, it means you must account for depreciation on the rental portion of the property, which affects your cost basis and therefore affects how much taxable gain you will have if you ever sell the home. Under the American Rescue Plan Act and subsequent IRS enforcement guidance, third-party payment platforms like Airbnb and VRBO are now required to issue Form 1099-K to any user who receives more than $600 in gross payments during the tax year. That 1099K is sent simultaneously to you and to the IRS. So, if you received rental income through one of these platforms and did not report it on your tax return, the IRS does not need to audit you to find out. They already have the data. Their matching system simply compares the 1099K they received against your filed return. And when the income does not appear on Schedule E, the system generates a notice. The most common notice in this situation is the CP 2000, which is an automated underorder notice. It is not an audit. It is worse than an audit in some ways because it is a computer-generated assessment that assumes you owe the tax on the unreported income plus interest plus a potential accuracy-related penalty. And if you do not respond to a CP 2000 notice within the time frame specified, usually 60 days, the proposed assessment becomes final and the IRS can begin collection actions, including filing a federal tax lien against your property. The fourth triggering event is the inherited property documentation gap. This one is especially cruel because it typically affects people who were going through one of the most difficult experiences of their lives when the mistake was made. When you inherit property, whether it is your deceased spouse's share of the family home, a vacation property from a parent, or a piece of land from a relative, the tax code provides one of its most valuable benefits, the stepped-up basis under IRC Section 1014. This means your cost basis in the inherited property is generally the fair market value at the date of death, not what the original owner paid for it years or decades earlier. This is enormously beneficial because it can eliminate or dramatically reduce capital gains tax if you later sell the property. But here is what most people do not realize. The stepped-up basis only works properly if it is documented. If the estate did not obtain a qualified appraisal at or near the date of death, if no Form 706 was filed for estates that met the filing threshold, if no records were created establishing the fair market value at the time of inheritance, then you are holding property with an undocumented basis. And under the IRS's current enforcement posture, an undocumented basis is treated as a zero basis until proven otherwise. That means if you sell an inherited property for $300,000 and you cannot document what your stepped-up basis should have been, the IRS can assess capital gains tax as if your basis were zero. On $300,000 of gain at the current long-term capital gains rates, that could mean a tax bill of $45,000 to $70,000 or more, depending on your total income and filing status. And the IRS is now actively identifying inherited properties through estate filing records and probate court data and matching them against subsequent sale records to determine whether proper basis documentation exists. Now, I want to address the question that I know is forming in your mind right now because it is the same question everyone asks when they hear this information for the first time. You are wondering how the IRS could possibly track all of this. How could they know that you added your daughter to your deed 3 years ago? How could they know that you rented your basement on Airbnb last summer? How could they know that your mother's house was never properly appraised when she passed away? And the answer to that question is what makes 2026 fundamentally different from every year that came before it. The IRS is no longer relying on random audits to find these issues. They are using a system that works around the clock, processes millions of records simultaneously, and never misses a match. The funding that Congress provided through the Inflation Reduction Act did not just hire more agents. It built a digital infrastructure that connects data sources that were never connected before. County recorder offices in most states now have data sharing agreements with the IRS. When a deed is recorded, when a title is transferred, when a lien is filed, that information enters a federal database. Mortgage servicers and home equity lenders report loan originations, balances, and interest payments directly to the IRS. Title companies report closing transactions. Short-term rental platforms report payments. Estate and probate courts report filings. And all of this data feeds into machine learning systems that compare it against every tax return associated with the property owners involved. The system is not looking for suspicious behavior. It is looking for gaps. A deed transfer with no Form 709, a 1,099K with no Schedule E, a home equity loan with a claimed interest deduction that does not match the loan's stated purpose, an inherited property sale with no documented basis. These are not judgment calls. They are mathematical comparisons. And when the system finds a gap, it generates a notice. By the time that notice arrives in your mailbox, the analysis is already complete. The IRS is not asking you whether there is a problem. They're telling you they have already found one. And that is why waiting to see if you get a letter is the most dangerous strategy you can possibly adopt right now. Because by the time the letter arrives, the voluntary compliance options that could have saved you thousands of dollars may have already expired. And that brings me to April 15th, 2026, and why that date is the most important deadline on the calendar for senior homeowners this year. Under current IRS policy, taxpayers who come forward voluntarily to correct past reporting errors before those errors are identified by the IRS through its matching systems are eligible for significantly more favorable treatment than those who wait until they receive a notice. This is not a special program invented for this video. This is a long-standing IRS principle codified in the Internal Revenue Manual. The IRS distinguishes between taxpayers who demonstrate good faith by voluntarily correcting mistakes and taxpayers who only address mistakes after being caught. First-time penalty abatement under IRM 20.1.3.6.1 is available to taxpayers who have a clean compliance history for the 3 prior years, who filed all required returns, and who have paid or arranged to pay any tax due. Reasonable cause penalty relief under IRC Section 6664C is available when a taxpayer can demonstrate that they acted in good faith and had reasonable cause for the error. These provisions exist. They are real, and they are dramatically more accessible to taxpayers who come forward before April 15th of the current filing year than to those who wait until the IRS contacts them after April 15th. The returns for the prior tax year become final. Amended returns can still be filed, but the window for proactive voluntary disclosure narrows. Penalties that have already been assessed through the automated matching system become significantly harder to abate, and the IRS's posture shifts from one of potential leniency to one of collection. So, let me walk you through exactly what you need to do right now. Not in general terms, not in vague suggestions, specific concrete steps that you can begin today. Step 1. Gather every document related to your home and your home finances going back to 2022. I want you to find your original purchase documents, the closing disclosure, or the HUD-1 settlement statement from when you bought the home. This document shows your original purchase price and the costs that were included in the transaction. Those costs factor into your basis in the home, which directly affects how much taxable gain you would have if you sell. Next, I want you to find records of every major improvement you have made to the property over the years. A new roof, a kitchen renovation, a bathroom addition, a finished basement, new windows, a new HVAC system. Under IRS rules outlined in Publication 523, the cost of permanent improvements to your home increases your basis. That higher basis reduces your taxable gain when you sell. Many seniors have spent tens of thousands of dollars improving their homes over the decades, but have never kept organized records. That missing documentation could be costing you real money. Then I want you to find any home equity loan or HELIC statements you have, the original loan agreement, the monthly or annual statements, any documentation that shows what the funds were used for. If you use the money for home improvements, receipts, and contractor invoices, connecting the loan to the improvement are critical. If you use the money for other purposes, you need to know that so you can assess whether interest was improperly deducted. Next, find any deed or title documents that show changes in ownership over the last 4 years. If you added someone to your deed, I want you to have the recorded deed and any correspondence from the title company or attorney who handled the change. And finally, if you have been renting any part of your home, gather your records of income received and expenses incurred, platform statements from Airbnb or VRBO, records of cleaning costs, supplies, repairs, and any advertising expenses related to the rental activity. Step 2, take your last 3 filed tax returns and lay them next to those documents. You do not need to be a tax expert to do this comparison. You are simply looking for things that do not match. Did you take out a HOA, but there is no mention of it anywhere on your return? Did you change your deed, but there is no Form 709 in your records? Did you receive rental income from a platform, but there is no Schedule E on your return? Did you sell or transfer property, but there is no Form 8949 or Schedule D? You are not trying to solve the problem at this stage. You are trying to identify whether a problem exists. Make a list of anything that looks like a gap or a mismatch. That list becomes your roadmap for Step 3. Step 3. Take that list to a qualified tax professional. And I want to be very specific about what qualified means in this context, because not every tax preparer is equipped to handle these issues. You want a certified public accountant or an enrolled agent who has specific experience with real estate taxation, property transfers, and IRS penalty procedures. An enrolled agent is a federally authorized tax practitioner who has passed a comprehensive IRS examination and is licensed to represent taxpayers before the IRS at all levels. You can find one through the National Association of Enrolled Agents directory at nia.org. You can find a CPA through the American Institute of CPAs at aicpa.org. When you call, ask one question before you schedule an appointment. Do you have experience with IRS penalty abatement for real estate-related compliance issues? If the answer is yes, you have found the right person. If the answer is hesitation or a vague response, keep looking. Step 4, create an account at irs.gov and access your tax transcript. This is one of the most powerful and underused tools available to American taxpayers, and it is completely free. Your IRS account transcript shows you every return that has been processed under your Social Security number. It shows you every notice or assessment that has been issued. It shows you every piece of third-party data, every 1099, every W-2, every 1099K from rental platforms that has been reported to the IRS and matched to your account. Setting up the account takes about 15 minutes. You will need to verify your identity through a process called ID.me, which involves uploading a photo ID and answering security questions. Once you are in, you can see exactly what the IRS sees. If there are pending notices you did not know about, they will be there. If there is 1,099K income from Airbnb that you did not report, it will be there. This is how you stop guessing and start knowing exactly where you stand. Step 5. If you have any IRS notices that you have already received but have not responded to, address them immediately. Every IRS notice has a response deadline printed on it. If that deadline has not yet passed, respond before it does. If the deadline has already passed, contact a tax professional immediately because an unanswered notice does not disappear. It escalates. An unanswered CP 2000 becomes a statutory notice of deficiency. An unanswered statutory notice becomes a final assessment. A final assessment becomes a collection action. A collection action can become a federal tax lien on your home. That progression is not instant. It takes months. But every step in that chain makes the situation harder and more expensive to resolve. The earlier you intervene, the more options you have and the less it costs. Now, I need to talk about something that I consider just as dangerous as the IRS penalties themselves. And that is the scammers who are going to use this situation to steal from vulnerable people. Every time there is a high-profile tax issue that affects seniors, the scam calls start within days. You will get phone calls from people claiming to be IRS agents demanding immediate payment. You will get emails with official looking IRS logos asking you to click a link and enter your personal information. You will see advertisements from companies promising to make your IRS problems disappear overnight for a large upfront fee. Let me be absolutely clear about how the real IRS operates. The IRS initiates contact through official United States Postal Service mail. They do not call you demanding immediate payment. They do not threaten you with arrest over the phone. They do not accept payment by gift card, wire transfer, or cryptocurrency. They do not send emails asking for personal or financial information. If anyone contacts you by phone, email, or if text claiming to be the IRS and creates urgency around immediate payment or personal information, it is a scam. Hang up. Delete the message. Protecting yourself from the IRS means taking proper tax action through proper channels.